The second panel is on analytic assessments of the costs and benefits of U.S. participation in international financial regulation. I'm Jason Furman, a senior fellow here at the Institute, and will be moderating this session. And in an attempt to get us back on schedule, will not repeat Adam's excellent introduction of our four Peterson Institute / in some cases, MIT and Georgetown friends who will be doing these presentations. Thank you. Oh, so we'll start with Anna.
Great. Thank you, Jason, and thank you, Adam, and thank you to everybody who made it out in the snow. So what I wanted to do was, in some sense, continue where Barbara left off and talk a bit about what it might mean to adopt a forcefully domestic perspective on international financial stability in the spirit of the February 3rd executive order, which, as you heard, specifically refers to international financial cooperation and advancing American interests in international fora. So I'm going to begin by asking what the U.S. domestic objectives might be for international financial stability, and I want to be quick there because a lot of folks have talked about it in very compelling ways. Then I'm going to talk briefly about what the existing domestic mandates and institutions are for international financial stability. I will assess the institutional architecture that emerged post-Dodd-Frank for its ability to advance U.S. interests in international financial stability. And finally, I'd like to play around with applying the same frame to the Choice Act, which was mentioned earlier, which is probably the most fully developed replacement proposal for Dodd-Frank coming out of the House Financial Services Committee and in the spirit of the executive order. So first, very briefly recapping, what is the U.S. substantive interest, our domestic interest in international financial stability? As you've heard already, the first bucket of interest would have to do with contagion and other spillover effects from crises abroad. Certainly Lehman, although Lehman is what everybody else cites as a contagion engine, but that's very much the idea going back to the crisis. Second bucket is the gaps and inconsistencies and overlaps in regulation of transnational capital flows and transnational institutions. Again, this is not new, going back to the BCCI incident and to the debate about market finance or shadow banking or whatever you want to call it. Third, and this is front and center in the executive order, we have an interest in U.S. firms being internationally competitive. And then fourth, the fourth bucket I see as crisis management, including liquidity provision in particular. Importantly, international coordination is not the only way to meet these financial stability objectives. Right? In particular, in theory at least, you could wall off your financial system, build buffers, and self-insure against spillovers and contagion in particular. Now, this is very much theoretical because I don't think anybody in this room, or frankly the executive order, doesn't reflect the belief that it is a viable alternative for the United States to wall itself off and build buffers as a way of managing financial stability risks. It might be for small emerging economies, but even that is a question mark. Moreover, if U.S. competitiveness is a concern, then coordination is even more important. And again, walling yourself off sort of contradicts the very predicate of competition. So second, given these objectives and interests, what is the U.S. domestic mandate for international financial stability coordination? There's actually a fair amount of legal authority and a fairly thick institutional architecture in the United States for international financial stability coordination, starting from participation in formal international institutions such as the IMF, authorized and overseen by legislation. There's long-standing executive and agency practice of transnational coordination, so the expert networks that produce what is known as soft law, so the non-binding but highly persuasive, shall we say, set of rules and norms that tend to govern the international financial space. You could even justify this by U.S. authority over foreign firms and extraterritorial reach of U.S. regulation. In other words, international regulatory coordination is unavoidable when your firms operate in multiple countries and when your laws reach far-off territories. Third, there's explicit authority to engage in financial operations. Of course, most prominent, the Federal Reserve's authority to operate in the foreign exchange markets, which frames the central bank swap lines that were so prominent in the last crisis. And then institutions like the Exchange Stabilization Fund at the Treasury. Again, the fact that we have express lending and international transactions authority in domestic institutions requires a certain amount of implies a certain amount of international coordination. Now then, there's also express legislative mandate to engage in international coordination, not participate in formal institutions, but do exactly the sort of soft lawmaking that is being done. As a matter of fact, some of this is authorized in U.S. legislation. Now, going back a while, International Lending Supervision Act of 1983 provided for coordination. But this is where Dodd-Frank really made a bit of a leap, recognizing the system that is in place, that was in place in 2010. And David Zering has written persuasively about this, where it actually contains explicit requirements for U.S. authorities to coordinate. Many of these requirements are defensive, right? So make sure you coordinate to understand and forestall some negative effects of foreign coordination, or foreign regulation rather, on U.S. firms. FSOC is certainly subject to some of these requirements. SEC and CFTC shall coordinate in the derivative space with their international counterparts. The Treasury Secretary and Federal Reserve and Board of Governors of the Federal Reserve are required by law to coordinate internationally. Dodd-Frank also contains a fair amount of authority rather than requirement to coordinate, and then mandates a bunch of studies of coordination. So this is baked into U.S. domestic statutes. And then, of course, there's the panoply of domestic institutions that are, as a matter of fact and as a matter of law, engaged in international financial stability coordination. Some of these are very old and so fit in with the conventional understanding of foreign affairs. So the executive branch, the White House's engagement in the various G processes, Treasury and State Departments' roles are not new whatsoever. As you heard, the Federal Reserve, both as a regulator and as a liquidity provider, has long been active in the international space. FDIC, OCC, the SEC, the CFTC all have international coordination functions that have very much contributed to the alphabet soup that you see on the international stage. Now, Dodd-Frank added a few, but relatively few letters to this alphabet soup. So there's the FSOC, the Financial Stability Oversight Council, chaired by the Secretary of the Treasury and comprising the main financial regulatory bodies, administrative agencies in the United States. The Office of Financial Research, supporting the work of FSOC. And then the new kid on the block, the Federal Insurance Office, which really reflects the fact that in the United States, insurance is only or very much primarily regulated at the state level. So this is a federal presence explicitly mandated to engage internationally by Dodd-Frank. Now, here's a question. Is this an effective institutional architecture to advance U.S. interests in international financial stability? How can we tell if it's effective? What are the criteria? So first, I would think that whoever is engaging internationally must be able to speak for the United States. And this means, by the way, when the United States decides not to cooperate, you still need somebody out there who can authoritatively speak for the U.S. It's also, so this means political responsiveness. You can't have somebody that does not fundamentally represent the will of the people and the interests of the United States at some level, but also the ability to coordinate domestically. Whoever goes out, the institutions, the domestic institutions that go out in the international space in the name of the United States have to be able to deliver domestic coordination. Related, these domestic institutions engaging internationally must have the capacity for some durable commitment. And this is particularly and self-evidently important with the stability mandate, right? How stable is stability if it changes all the time? So durable commitment is rather important in this space. These institutions must be both internally and externally intelligible. This is really as a prerequisite to accountability. In other words, foreign counterparts and domestic constituents need to know who do you call, which part of the alphabet do you address when you have a particular problem. And it goes without saying, must have necessary expertise. So let's assess how the post-Dodd-Frank U.S. institutional architecture and how the institutional architecture that might come in place with the Choice Act, should it be enacted or anything like it, how do they stack up by these standards? So the post-Dodd-Frank architecture is kind of a mixed bag. Financial Stability Oversight Council can be seen as a move both to increase political responsiveness, putting the Treasury Secretary, a political appointee, at the helm, and internal coordination, being able to deliver domestic agencies on the international arena. Also, some more legislative control, I think, would be fair to say. Now, if durable commitment is your worry, then I guess it would be better achieved through something like an independent central bank leading the U.S. financial stability coordination effort. And so the increased role of the Fed, even with the ascendance of FSOC, is, I think, can be seen as an effort to balance these, would deliver some form of balance between these imperatives. Dodd-Frank can also be seen as a marginal improvement on the intelligibility front. So again, more centralized coordination in FSOC, and in the OFR, there's a centralized research function, analytical function. This is where you go for data consistency. But there's still considerable fragmentation, and we did not do a whole huge lot on the consolidating and eliminating duplicative functions and agencies front. Now, would the Choice Act be an improvement? Here's my take on the Choice Act. I think it would, first of all, subject the current soft lawmaking coordination process that was least favorably described in the famous McHenry letter to robust advanced administrative notice and comment and congressional oversight process, right? So that basically is a complete turnabout in the international financial stability coordination process. The Federal Reserve, FDIC, all the regulatory agencies, before going to these coordination fora, would have to go to Congress, would have to submit whatever they might be doing to notice and comment, publicly release positions, talk about the impact of these potential outcomes in the international stage. This is just a dramatically different process. Would it be better? Would it be worse? I have no idea, but it would be completely different from what we have now. So as a domestic matter, this is just would be a total turnaround. It would severely curtail FSOC's mandate, creating an off-ramp for banks, removing FSOC's capacity to designate non-banks as systemically important, removing a lot of the enhanced supervision capacity that came with designation. It would eliminate OFR, which, is not the end of the world in one sense, but it does not exactly replace it with a centralized coordination point for data consistency and participation in international standards bodies. It would further curtail Federal Reserve emergency lending powers, FDIC guarantee powers, ESF capacity to intervene in a crisis. That is not, strictly speaking, a curtailment of international coordination powers, but certainly curtailing liquidity provision capacity, I think would diminish the influence of these institutions internationally. And then it would expressly go back on a bunch of US commitments in areas such as cross-border resolution and capital adequacy, et cetera, et cetera. So in the end, the Choice Act would dramatically improve political responsiveness, but would also dramatically, in my view, undermine the US ability to make durable commitments and our credibility. It would make US institutional architecture domestically a lot more fragmented and less intelligible. And I don't think that the result, as it stands, would help the cause of advancing US interest in international financial stability, particularly under the terms of the executive order, if we take it at its face value. So thank you.
So Simon Johnson next.
Thanks very much. My name is Simon Johnson. My topic is cooperation and crisis prevention. And just to remind you, the context of this panel is, well, the title for this panel is Analytical Assessments of the Costs and Benefits of U.S. Participation in International Financial Regulation. I have 12 minutes to address a truly vast topic, and I will make just 3 points, if you'll allow. The first is about, and I'll make each of these 3 points in general terms. I'll try and talk also about specific historical episodes, and I'll mention one firm associated with each of these points, just to try and make sure we get sufficiently concrete. And the firms are going to be Lehman Brothers, UBS, and AIG. So the first point is about bankruptcy or failure for cross-border financial institutions. I think you've all heard the Mervyn King line that global banks, very large banks, live globally and die locally. And we've put a lot of thought, many people in this room and other people in around the official sector, put a lot of thought into how to handle failure of large financial firms in a way that's different from what happened in September 2008 with Lehman Brothers, and to create more options, different options, hopefully better options for officials next time. I think, by the way, to this point of crisis prevention, you can't prevent crises completely. I'd be very surprised if anyone in the room would take the opposite side of that. I think we're talking about limiting the impact of financial distress and preventing that from becoming major financial crisis, major economic crises. And clearly, that didn't go well in the fall of 2008. Now, the agency charged or that's had the lead on this issue for the United States is the FDIC, and I'm on their Systemic Resolution Advisory Committee, but I'm not speaking about my views or that committee's views. I'm talking about my understanding of the FDIC's work here, which is completely in the public domain. And I think that a great deal of progress has been made with regards to the potential for cooperation between official liquidators in the event of invoking Title II in the United States, so that the FDIC and the Federal Reserve would be in charge of winding down a firm, transferring viable assets to a new firm, and ensuring there's sufficient financing. I think that they have, I know they've worked very hard on cooperating with the Bank of England. I think other European authorities, perhaps Nicholas can speak to this, I think they would also be in a suitably positive frame of mind if we were to come to that rather unfortunate juncture. However, one other point that I think comes through very clearly from the analytical assessments that the FDIC has done on this topic is that if the US chooses not to use Title II, but instead relies solely on bankruptcy, and this is, as you know, is one of the proposals currently before Congress. So Title II may be scrapped, it's entirely possible, and you only need 50 votes in the Senate to do that, by the way, so it's absolutely on some people's agenda. How much cooperation would you get between the United States, bankruptcy judges, for example, and the European authorities? in the UK, which is obviously a key jurisdiction for these issues, or the European Union. And I think the answer, this has been looked at very carefully, I think the answer is quite clear. You would get no cooperation, essentially no cooperation. Certainly no cooperation you can plan on, no cooperation around which you could structure expectations. You would be back in the world, and Patrick's looking a little pale when I say this, the world of fall 2008, where it's everybody grabs the assets that they have available in their jurisdiction because they're not quite sure what liabilities are also in their jurisdiction, and you have a responsibility to protect your own financial system and your own depositors, your own creditors. I mean, this is purely rational officials, rational, well-informed officials, implementing their legislative mandate. And it's chaos, and it's a disaster. If Representative McHenry and other people who are urging the U.S. disengagement from international regulation and other forms of international cooperation, if he and his colleagues really want us to go to this world of bankruptcy-only failure for the large financial institutions, this is a world of Lehman Brothers and the consequence of the collapse of Lehman Brothers, pure and simple. Now, the second point about cooperation is with regard to capital. And I think Christine gave an absolutely brilliant presentation this morning in terms of the origins of our thinking about capital and about capital regulation. I'm certainly not going to repeat that. In terms of the analytical assessments, my preferred reading on this is the book by Anat Admati and Martin Hellwig, The Banker's New Clothes. Obviously, there are some controversies here, and the Peterson Institute will be coming out with a pair of studies quite soon with somewhat different views on this issue. So hopefully we'll meet again and discuss at that time. I think with regard to this topic, the international cooperation, let's remember what happened in the previous experience. Now, I was recently in a conversation with a senior executive at UBS, and this person said, unprompted, that they had leverage, 55 times leverage at UBS, one of the largest banks in the world. So that's less than 2% equity for those of you doing the math at home. Now, if there is currently a push, and you've noticed, I'm sure, a fairly concerted push in the United States to lower required capital levels. There's plenty of discussion around that, and that I think is where we should expect, unfortunately, that officials will end up going over the next couple of years. In the last crisis, would it have been better or worse for us if the U.S. had less capital than it actually had? If the U.S. had given up on the leverage ratio, Christine gave you the historical context for that, there was a very active discussion about should the leverage ratio be retained by the U.S. In the Basel II framework, Europeans, Nicholas can correct me, but my understanding is the Europeans were strongly the view, no need for the leverage ratio, we've got this with the clever capital calculations, internal models and so on, give up on the leverage ratio already. And the US, for various interesting reasons, didn't or hadn't got to the point of agreeing to that. Thank goodness. I mean, the definition of a crisis, financial crisis, surely is a moment when the risk weights are wrong. I mean, they're always wrong in a crisis. That's a crisis. So, and what happens if you don't cooperate on capital? If you don't have some agreement on your capital requirements, if you don't at least understand and watch carefully what's happening in other major jurisdictions with regards to capital, I think what you get is what we saw in 2007, 2008, which is a lot of activities being moved off balance sheet, away from the United States, run out of low capital jurisdictions, like the UK. And this leads to much worse outcomes. No, we can do more studies, we can have more argument about that if you want, but I think the historical evidence is pretty uncontroversial. Now, this leads me to my third point, which is perhaps slightly different or somewhat more, not exactly a change of topic from what we saw in the last financial crisis, but surely we can agree that financial technology marches on irrespective of what reservations we may have. And the financial innovation will always be with us. And personally, I'm fine with allowing financial innovation. My concern is that the form of innovation we've had in the past has too frequently, when it gets into trouble, when we have some sort of disturbance or crisis around that, it's too often spread to affect our basic financial requirements. And I think the issue that starts to come up now actively among central banks is can we shape our technology future in such a way across major jurisdictions, for example, such as those represented here, so that we have a stronger required minimum infrastructure in the public interest that can function irrespective of what happens in the next AIG financial products, for example. I mean, if somebody writes some insurance products that go wrong, well, that happens all the time. If they go wrong on a large scale, yes, there is some concern there, but it's the way those impact the basic banking. Can I use my credit card? Can I take cash out of an ATM? Can I make payroll? These are absolutely essential functions. We had a snowstorm, a small snowstorm overnight in Washington, D.C., and the lights are still on. Doesn't happen every time. That is essential, critical national infrastructure run by the private sector with some very clear performance requirements and a set of expectations and a set of regulations that come around that. I would like the lights to stay on, irrespective of whatever clever schemes somebody comes up with a financial sector that happens to unravel. Now, I have to say, I'm sorry that Barbara isn't here, because I was going to try and engage her on some of this. I think BlackRock is a very impressive firm. I'm going to throw it out there, and you can tell me now or tell me later, but I'm going to contend it's one of the most successful firms in the history of the world, outside of finance as well, in terms of its growth, in terms of its size, in terms of how it's run now. I should also declare that Ben Golub, who's the chief risk officer at BlackRock, is a donor to MIT, full disclosure. It doesn't give me any money, but just get that out there. Now, how do we feel about asset management having become large and becoming large relative to banks? I feel pretty good about that in general terms. I think banks are dangerous because of the leverage, with 200 years of vivid demonstration of that. Asset management, if run carefully, is actually a force for stability, and maybe starting to move me towards the stronger, better infrastructure. Now, it can go wrong, there's no question, and strong reservations have been expressed, for example, about leveraged exchange-traded funds, ETFs. Those reservations, I was just checking the latest quotes from one of the leading people expressing those reservations is Larry Fink, CEO of BlackRock. Money market funds, we clearly experienced in the fall of 2008, if they are perceived as being bank-like, so you have their implicit leverage, or you have an expectation you're going to make a fixed payment and suddenly you can't, clearly there's a problem there. So I'm not saying anything is necessarily safe, and I'm certainly asking the same question that Larry Fink is asking, which is, are the products safe, particularly the core products that we're using to make payments, and that we're using for very simple vanilla credit, perhaps? And if the discussion now moves towards the so-called central bank digital currency, what should a central bank offer in terms of digital financial services? To what extent does a central bank have a responsibility, or not saying that it necessarily runs the system itself, but does it insist that there be a critical private infrastructure that is resilient? I think we can learn a lot from asset management. I think we can learn a lot from which products are actually very safe and which ones we're comfortable having being run by private firms, as long as they're not what? Not highly leveraged? Absolutely. They don't have complex, opaque derivatives that we don't understand and they don't understand. And I think we can lay out other requirements and expectations for that. If we do this between the major central banks, between the US and Europe, and the UK, now a separate category, then I think we're much more likely to get stronger, more robust infrastructure. And then we can allow financial innovation and we can allow risk-taking without blowing up core financial services and the economy. And I cede my remaining 2 seconds back to the chair.
So Ted Truman on his excellent issue brief that you should all have.
Hope I can do this. This goes forward? Okay. This goes back. Thank you very much. It's a pleasure to be here. I'm following, I'm now going to tell a supervisory story. Just to keep, following Simon, I'm reminded of my rule when I was at the Federal Reserve many thousand years ago, which was never speak after Bill Taylor. Because Bill Taylor was always much more entertaining than I could ever possibly be. And I think you will learn that. I'm nice and dull. But I've learned a lot here. And I went to school, by the way, at the Bill Taylor Regulatory Supervisory School. So we're here to talk. I'm going to draw from my policy brief on international financial cooperation and the benefits to the United States. So, what are the stakes? I may violate your rule a little bit here, Adam, but that's the life. So the financial crisis of the great financial crisis became a global conflagration because of the interconnectedness of countries' economies and financial systems around the world, and containing and stabilizing these interwoven systems and averting scaling back future crises. I agree 100% with Simon on that one. Requires international cooperation, and that rests on two pillars: crisis prevention and crisis management. Not that they're completely separate. The Trump administration's intentions in this area are unclear. I think I'll post, some over here. But early indications are that there may be some reason to be concerned about the U.S. commitments to U.S. international regulatory agreements and institutions that would prevent and manage the inevitable occurrence of future crises. We may see a shift away from the approach towards international institutions of cooperation that has been the central pillar of American foreign policy since the end of World War II. We have used those institutions to promote U.S. policies, a discussion that the first panel spent a lot of time on, and U.S. interests broadly defined. The central question now is whether the new administration will define U.S. interests narrowly or broadly. So on crisis prevention, I'm going to be brief, if I can find my notes here. I can be brief. President Trump has declared, as we know, that his administration will do a big number on the Dodd-Frank Act. Anna Gelpern told us what that might or might not mean. But the important point, and I think she made this point as her usual eloquence, that law was the cornerstone not only of the post-crisis reforms in the U.S. financial system, but also the cornerstone of U.S. cooperation with other governments and regulatory authorities around the world to strengthen the resilience of the financial system. The cooperation focused on the work of the Basel institutions, that set of alphabet soup we talked about, and repealing and stepping away from the institutions of cooperations, as many Republicans in Congress say they would want to do, could, at least with administration backing, weaken the norms and standards that have developed to support U.S. and global stability. Financial stability, U.S. financial stability has been adequately pointed out, more than pointed out, relying on global financial stability. So the possible casualties of U.S. financial regulation could include derailment of the agreement on the final chapter of Basel III. It also could lead to several other negative outcomes. I include on my list, not everybody's going to agree with this. I know that the lunch speaker doesn't agree with this one. Keynote speaker, the Honorable Nathan Sheets. The Volcker rule limiting proprietary trading by U.S. banks might be abandoned, creating a de facto conflicts with other jurisdictions that have adopted similar efforts to essentially ring-fence bank depositors. The U.S. might no longer identify some or all U.S. financial institutions as systemically important, putting the U.S. in conflict with such identifications by the FSB and other national jurisdictions. Deregulation could, as we've already heard, alter the orderly liquidation authority of the provisions of the Dodd-Frank Act, undercutting global efforts to establish a common global framework in this area. And finally, it could force the Federal Reserve to abandon its comprehensive capital analysis reviews processes, and that would increase pressures abroad to scale back the use of stress tests. So this regime has been substantially stressed in the last 10 years since the global financial crisis, and a breakdown of negotiations over Basel III and a halt to future cooperation would be a severe blow to progress on crisis prevention. If the U.S. were to withdraw from activities centered in the FSB, the United States would lose influence over these activities. I think we established that in the first panel. If the United States were to scale back its participation, the post-crisis regime would be incomplete, fragmenting the supervision and regulation of internationally active financial institutions and the global financial system. So that's what I have to say about the crisis prevention material. And I'm going to spend most of my time on crisis management, assuming I still have some more time. With respect to crisis management, a possible signal of the intentions of the White House is the desire to substantially reduce U.S. funding of international organizations with deep cuts in international programs. If these reports are correct and the Congress goes along, the tools of crisis management are likely to be adversely effective. The global financial safety net, centered in the IMF, is a major tool of crisis management at the global level. The global financial safety net was initially strengthened during the global financial crisis, but the IMF has already been weakened relative to the plans laid down at that time. And subsequent efforts were delayed and finally grind to a halt. And it's useful to see where we are now. With respect to IMF resources and governance, the G20 leaders approved an acceleration from the end of 2016 to the end of 2014 of a further review of IMF quota subscriptions as part of their agreement in Seoul in 2010. That quota review was derailed by the long delay in U.S. approval of the Seoul Agreement. It's now to be completed by the fall of 2019. The Trump administration may not be eager to agree to a further increase in the U.S. quota in the fund. The United States can block or veto any agreement on an increase in IMF quota because it has a 16.5% share of the votes in the fund, and a majority vote of 85% is needed by the governors if the fund is to pass any resolution proposing an increase in quota. If the United States wants to support a substantial increase in all quotas and preserve its veto over certain decisions of the fund, it would have to agree to an increase in the U.S. quota. Without an increase in the U.S. quota, any increase in total IMF quotas of more than 9% would push the U.S. voting share to under 15%, the veto point. I'm an economist, so I added one calculation here rather than all words. Now, the Trump administration could agree to a large increase in total quotas without increasing the U.S. quota, allowing the U.S. voting share to decline before 15%, or it could agree to a significant increase in the U.S. quota. If the administration chooses the second approach, would it tie implementation to the agreement to congressional approval, as was the case with the 2010 agreement? The Trump administration could either adopt the first posture or the second without a link to congressional approval. Note that under the second approach, the United States would not necessarily lose its veto, it would be up to the Congress. My view is that if the United States, under any administration, does not value the contribution of the IMF to global and therefore U.S. economic growth and financial stability, at least it should get out of the way and not block IMF quota and reform efforts. If the United States is uncooperative, other members could establish a set of financing arrangements linked to the fund that do not include the United States. The IMF's supplementary borrowing requirements, in which the U.S. is not a participant, are a move in this direction. But the real existential question for the United States is participation in the fund. This issue will come to a head over the next 4 years, not only in the form of U.S. posture on increasing IMF quotas, but also with respect to U.S. participation in the IMF's so-called new arrangements to borrow, the NAB. It is a supplementary, de facto permanent source of financial resources from 38 member countries that include the United States. I'm not going to go a bit deep into the weeds here, but the matter is poorly understood and I believe very consequential. When the IMF passed legislation at the end of 2015, Congress passed legislation in 2015 approving the Seoul Agreement, it included a provision that U.S. participation in the 2022 renewal of the NAB be subject to congressional approval of our $38.5 billion commitment. The United States will have to, the current rule is already in train, set up by Mr. Sheets. The United States will have to decide by November 2021 whether to support the NAB renewal starting in 2022, and judging by past efforts to persuade the Congress to pass legislation in support of the IMF, particularly when large amounts of money are involved, what's that say, two? I think I can make it, would be a heavy lift for any administration. A second Trump administration or a new president's administration would have to deal with the IMF timetable and preliminary discussions that occur prior to the 2020 election. So would U.S. withdrawal from the NAB kill the IMF? If the fund could continue to limp along and seek to augment its resources through other borrowing, but obviously, and this is where the international cooperation comes in, I think the phrase is, he who pays the piper calls the tune, and if we stop supporting these institutions financially, we will call many fewer tunes. So, in effect, this question, that's where the existential question comes up, is whether whether this decision or sequence of decisions is going to lead to a situation that is tantamount to U.S. withdrawal from the International Monetary Fund. I'm going to make one other point since I know I'm slightly out of time. We're going to get an early test of all this in the budget agreement that is going to be announced, I guess. Budget proposal is going to be announced later this week, we think, or something like that. And whether they, in fact, do scale out back our support for international financial institutions. If they did so, the IMF doesn't need money right away, but the World Bank and various other international financial institutions do. If it was scaled back substantially, it would be the first signal of our intention. Our intentions, again, it would not cripple these institutions, but it would certainly weaken our role in the institutions. So we will have a test of where we're going very soon. I could simply, that was about that. So in conclusion, get to my last page, wherever it is. The Trump administration may in time fully recognize the contributions that international financial cooperation makes to the economic and financial health of security of the United States, but that's far from certain. On crisis prevention, my view is reforming and replacing the Dodd-Frank Act is likely to weaken the U.S. financial system, not that all reforms would do so, and could well place the U.S. standards in conflict with some of the international standards agreed on after the global financial crisis, or still under discussion. And if the United States discontinues playing a positive role in the international standard-setting bodies, financial reform will grind to a halt. On crisis management, if future U.S. support for the institution of international monetary cooperation, in particular the IMF, is minimal at best and negative at worst, the inevitable financial crises will be more challenging to handle and more dangerous for the United States. Thank you very much.
So, and speaking on behalf of the rest of the world, Nicholas Farrell.
Wow. Indeed, we heard a lot about the pros and cons about U.S. participation in international financial cooperation. I guess we heard more pros than cons. In a way, I'm trying to answer here a different question under Adam's directions, which is a more narrow question, which is not why the U.S. should engage, but what happens if it doesn't. And the answer I'm going to submit frustratingly and predictably is it depends, it's complicated. We actually had a taste of this in the first panel, I think. But there are precedents of things happening in international financial cooperation without US leadership or even engagement. And there are also possible prospects for it. So that's what I'm going to explore in this presentation. So that's the alphabet soup. You had a longer list from Barbara. For the record, I'm not convinced there is a lot of scope here for simplification. I could actually imagine the soup becoming more hearty and thicker. And obviously, I didn't list all the organizations here. Actually, importantly, most of these organizations are not treaty-based. I didn't put the IMF, the World Bank, and the OECD on that list. I put the BIS, but the BIS is there mostly as a host to standard-setting organizations. Most of the standard-setting things that happens at the international level is not done by treaty-based organization, or in the case of the BIS, is just hosted by a treaty-based organization. And that's by design in a way, because there is no agreement to do that standard setting within a treaty. The other thing is that this list includes, and that has been already much debated in our session, things that have to do with financial stability, but also things that have to do with market integrity, transparency, different things that don't have a direct fiscal or quasi-fiscal implications, including in a crisis. I'm thinking about market conduct, accounting standards. I could have added auditing and things like that. So there's a variety of objectives here. Now, in many of those cases, and especially recent ones, I'm not going through the individual stories for lack of time, the US has provided leadership when creating those venues and organizations, even so the assessment of leadership is always a bit judgmental, I guess. But there are also cases where the leadership came from elsewhere, especially if you go a bit farther back in time. The BIS was very much the brainchild of Mr. Schacht. The ISB was very much the brainchild of Mr. Benson, who was British. And the Basel Committee, if you read Charles Goodhart reference history, was actually very much a consequence of an earlier initiative, which was purely EC6, as we would call it today, not even with the UK, even so the UK was in the prospect of joining the EC at the time. So I think this gives a bit of nuance on the indispensable role of the US. The US, of course, endorsed all these initiatives. It was not necessarily the leader at the creation, even so generally it was present in some way. The governance, more to the point of what's happening now, provides a lot of flexibility, and this echoes what I was saying before on many of those organizations not being treaty-based. The decisions are typically by consensus. There are very few formal voting arrangements. There are some in some organizations. And this is linked to the fact that the standards are typically non-binding. And this actually creates a lot of flexibility in how to deal with reluctant jurisdictions. There is a saying in some of those standard setters, which is compliance is influence. So you don't vote, but if you don't comply with the standards, nobody listens to you. And this is not entirely true. Of course, this is modulated by geopolitical heft, and the bigger jurisdictions by design have, or by necessity, have more heft than smaller jurisdictions. But at the same level of scale or heft, better compliance gives better influence. And this, in a way, diffuses the risk of obstructionism, right? If you're a jurisdiction that doesn't comply, you cannot really block the process because the discussion is mostly about people who are compliant. And that's also important to have in mind in a number of scenarios in which the US would not care about what happens in these venues. Now, I want to challenge the conventional wisdom that the US, A, is indispensable, B, engages more when there is a more internationalist administration. And the quintessential case study for this is international accounting standards. So I'm not going through a complex saga here, just to say that IFRS, International Financial Reporting Standards, have been adopted by the EU in a process that lasted between 2000 and 2002 for the decision-making and was fully implemented by 2005, 2006. And this really created a bandwagon effect throughout the world. Not all other jurisdictions than the US have adopted IFRS the way the EU has, but it comes pretty close. And the US Securities and Exchange Commission, which is the competent authority for this in the US legal order, actually made a big concession to this international project by allowing foreign private issuers in 2007 to use IFRS as an alternative to US GAAP and without reconciliation requirement. It even in 2008, under the leadership of then Chairman Chris Cox, envisaged a path towards full adoption of IFRS for US issuers, but there has been no progress since Lehman. And as you remember, Lehman was also largely blamed on the same chairman, Chris Cox, for his failure, I guess that's a word, to properly supervise broker-dealers from a prudential standpoint. So there are multiple ironies here. One is that, as is not mentioned in this slide, the SEC was actually behind the reform of the ISB, which made its standards acceptable to the EU in the late 90s. But the bigger irony here is that the Bush administration was actually more constructive from an international standpoint, even so it didn't provide the leadership which was provided by the EU. It was more constructive than the Obama administration. This thing has been completely frozen in the last 8 years. And not coincidentally, this issue is not about financial stability, but it's actually very important from an international perspective in terms of market integration, but also transparency, market integrity, and investor protection. So I think this is an example to keep in mind when we think about the Bush administration. We may be surprised that in some areas it's not getting more difficult, it may even be getting easier. Now, this is only one case among many, and if I think of other big cases of international financial regulation in the last few years, there's a whole variety of different patterns. The US clearly provided leadership since 2008 in the G20 reform of derivatives markets, and this is probably the moment to do like Simon, and for disclosure says that I'm a board member at the trade repository of DTCC, also known as DerivServe, and I can only echo, even though I'm not speaking in that capacity, what Barbara said about the difficulty to aggregate data. We have this failed experiment in international cooperation, which has to do with the way it went in terms of leadership and it was constructed. We have Basel III, which was largely a US-driven project, if not entirely. We have bank resolution frameworks. I think we had a very good exposition of this earlier, particularly by Patrick, I think, and others. But there are also examples, others than accounting, where leadership came from other jurisdictions. The adoption of Basel II was not a great success in terms of financial stability. Patrick reminded us of that, but it was very much driven by the EU, and it's still the received wisdom in Brussels, believe it or not, that the EU is better than the US at complying with Basel III, which we can discuss. And insurance capital standards, which is an ongoing project, a bit below the radar, but impactful for international insurers, is also not a US-led exercise. Actually, in some cases, the leadership came from the private sector. In a way, that's the case of international accounting standards. It's certainly the case of anything that happened in derivatives, and some stuff happened in derivatives before 2008, including the standardization of contracts by ISDA and the like. So, a nuanced view of the precedents. Now, the big question now is, okay, if the US doesn't provide leadership, can the EU do it? And this is the question of European Union internationalism. This is a paper which is forthcoming later this year by Elliot Posner, a political scientist, and myself, looking at EU internationalism in financial regulation. And we have two scores. One is integrationist. Does the EU or the US, for that matter, contribute to cross-border integration of financial systems and financial markets? And the other score is transnationalist. Does the jurisdiction promote a transnational way of doing policy and setting standards? And what you can see is that the US has declined a bit, and not at all on the first and not at all on the second. The EU has declined a lot through the crisis on both counts. It has become less integrationist, less transnationalist, and therefore, in our understanding, less internationalist in its approach to global financial regulation, and strikingly so. I don't have the time, or I don't want to take the time here to discuss why, but the big question is, well, can the EU return to its stance pre-crisis, where it was a big champion of international financial cooperation, as I mentioned, with accounting and Basel II? And there are different views here. One could say no, because the coalition that led to this stance, including in respect to the role of the UK, is no longer there. Or we can say yes, and in a way it was hinted at earlier this morning, I think, by Patrick, because we have stronger EU institutions now, the ECB as a supervisor, ESMA, etc., which can play a bigger role in international forums, better incentives and more heft. There is also, of course, the question of the impact of Brexit, which is a bit early to tell. The same question, which was not the case pre-crisis, applies to China. And I think it might seem provocative to talk about Chinese internationalism in an area of global financial regulation. But when I look at climate change, or even when I look at trade, I'm impressed by how quickly China has at least claimed the mantle of international leadership on issues where it was not known as especially cooperative as recently as a few years ago. And one could, I think, imagine something similar happening to international financial regulation. And indeed, China has a big interest in global financial stability because it has a big interest in stability. This is a Chinese obsession. Now, of course, there's an imperative of domestic controls that can severely impair the actual ability of China to be constructive or let alone take leadership in these international fora. And I think this is a space to observe very carefully in the next few years. What will be the actual issues? Here my list overlaps a bit with that submitted by Ted in his presentation. Basel III completion, also known by some as Basel IV, is an obvious point. International clearinghouses is a major issue that remains unresolved, and Chris Cumming reminded us of this this morning. There is a major need for international initiatives to tame the risks that is now being concentrated in those clearinghouses. And let me be clear that this doesn't overlap with my board membership that I mentioned before, because DTCC doesn't clear derivatives nationally, let alone internationally. Cross-border bank resolution does now have a framework. We've been reminded of that in theory, but we don't know how it works in practice. And we were reminded of the difficulties of home host and the Basel Accord since the beginning of Basel. And I think we still have a lot of discovery ahead on how the beautiful new convergence in terms of resolution frameworks under the aegis of the FSB works in a real crisis. And obviously conduct is a big issue because the US has been providing enormous leadership, unquestionably, on conduct issues if you think of market misconduct, LIBOR, etc., and especially if you think of sanctions. And here we really have no precedent of leadership that doesn't come from the US in international conduct of business and integrity issues. So here I should conclude, and I look at Jason. Basically what I said is international financial regulation can work without leadership, US leadership. It's not logically impossible to imagine situations where it would work without US leadership, especially in a situation of deregulation where you can have an easier alignment in a way between international cooperation, private sector incentives, and what other jurisdictions want. And that's, for example, what happened in international accounting standards. But you need an alternative leadership, and it's still unclear whether it can be provided by the EU or China, which are the two biggest jurisdictions by far outside of the US, or anyone else for that matter. So let me stop there and look forward to our discussion. Thank you very much.
Okay, so if everyone could come take their seats. So wanted to start with two questions from all of you on those excellent, provocative, and really complementary discussions, and then open it up to questions anyone else would have. The first question is, try really, really hard, and this may be a task too hard for any of you, to put yourselves in the shoes of the administration, some of the Republicans in Congress, and tell me whether you can think of any ways in which, in a meaningful sense, international cooperation can be adverse to the interests of the United States, and then to the degree that it is, what the right response to that is. Is it you win some, you lose some, but on balance it's good, or there's a way in an America first, putting us at the top of things, to redefine a better deal for our country? And anyone who wants to take it, and happy for everyone to answer.
Well, I think there's an example for which we can refer to Peterson Institute research, and that's insurance standards, because we had a very thought-provoking piece by Avinash Persaud last year on Solvency II and how not to regulate insurance, and even so, the proposals at the international level for insurance standards are not identical to Solvency II. They're very much in the same spirit. So I think this is one, in a way, easy one to start the discussion. where the US hasn't been providing a lot of leadership, as I mentioned before, but could actually make a stand that what's being cooked up in the international system is not aligned with interest. So I could think of that one, if perhaps of no other.
Yeah, Jason, I think with regard to bank capital and bank regulation, the U.S. has long had the ability to have more stringent regulation and higher capital requirements than other countries. So you can we already have the proven authority to stand back from a race to the bottom and decide our own terms for that. I don't think that's the interest of this administration. I think they want to lead the race to the bottom. That's the problem. And I think this whole issue of compromised international sovereignty is a complete smokescreen. Yeah, the British have some issues with regard to the European Union. It is a substantial issue for Brexit. It's completely irrelevant for the United States in this sphere.
Okay. Anna? Now, the next question I had is if Nicola is right and the rest of the world can proceed ahead without the United States, whether that's Europe or China. Does anyone want to speculate and help draw out what some of the consequences would be from a U.S. perspective, what we'd be losing from ceding some of that ground to others, or maybe what the opportunities to gain, if you think there are any?
Well, I think, obviously, we would lose influence. In some sense, if we were to back off, right, from this process, we would lose influence over the process, right? Then we might be in the world in which you have the rest of the world would go off in a direction which we actually didn't approve of, and therefore you would have a weaker set of standards globally, and that would impact back on the United States. So I think the major problem is whatever you think about whether we have led constructively or not, if you want to put it that way, or how much we have been essential to the process or not, and we have led dramatically, and I think, and this goes back to your first question, the challenge is in a world of absolutes, right? You cannot no agreement that I've ever had anything to deal with has been perfect from the standpoint of my position as one of the negotiators. Meaningless communique that argued over until 3 o'clock in the morning, right, has been perfect from the U.S. perspective, right? So you had to win some and so you had to lose some. They were all irrelevant almost but you had to win some, and the ability to compromise is really the big problem here, right? And they recognize that to some extent in every one of these agreements there's got to be a little bit of give and take, or you're not going to get to anywhere.
Right. But for you or for others, just to be more tangible, in some sense, by definition, if we're not involved in something, we're going to have less influence. But who cares? What does that mean? In what way are people in the United States going to be poorer or at risk because of that, or the opposite?
Well, the answer is to the extent that the Peterson Institute for International Economics, to use us as an unbiased observer, right, think that what the rest of the world is doing is a mistake, right, lowering capital standards, right, for example, or that's going in the wrong way in the insurance business, if you want to put it that way. That weakens the global system. Then we are impacted, and I think that's maybe I'm being too generalized.
It's not necessarily the case that the rest of the world will do worse or bad things if the U.S. doesn't provide leadership. Again, I want to refer to the example of accounting standards, because it's not about prudential, it's not about financial stability. It shouldn't actually be about financial stability. That's a debate. But I think it's interesting, because here is a case where a lot of things have happened in the last 15, 20 years, and the US has been disengaged and not very constructive. Now, what can we observe? The US has been influential in the international standard setting organization. It continues to be influential. Its influence is decreasing over time, both informally and formally. Actually, the number of US trustees is being reduced. That has happened recently. And there are huge pressures to just kick the US out, because they keep saying they will engage, but they don't, and at the end of the day, everybody is annoyed with that. So in a way, that could be a sort of preview of things to come. And I think, frankly, if we have a US administration that is distinctly unconstructive at a broader level in international matters, it will dramatically accelerate the momentum towards kicking the US out of the whole framework. Now, is it bad for the US? In a way, yes. I mean, US GAAP used to be the gold standard in international accounting. It no longer is. If you look at cross-border listings, 15 years ago, they were all using US GAAP. Now they're all using IFRS. So there is a measurable loss of US influence internationally in that space. And I think we can take this as a good example of what could happen.
Great. Anna.
And I just wanted to pick up where Nicola left off. I think a lot of it
I think
is
you need to
not-
press you.
A lot of it is not about necessarily what requirements are ultimately apply to our firms, but the fact that we have no say. And then ultimately you have US firms playing by rules that they didn't necessarily have any input in. But then the other piece of it is that even if our firms are unaffected and the rest of the world just goes to town and loosens all the standards, right? So no capital, no liquidity, have a party, right? This is a world in which we have historically and will continue to have a backstop liquidity risk, right? So we're going to be the ones who will have to manage the implosion of a system that we had no hand in fortifying. And I think that that is important, but it's also something that is very hard to make concrete to people today. You know, that 5 years from now, the Fed will be bailing out institutions in countries you've never heard of. And I think that that's a hard sell.
Great. Why don't we open up to questions? Bill. And I think a microphone's coming your way.
I'm Bill Klein here at the Institute. I'm trying to work through the seeming contradiction. This is kind of following up on Noriel's question. On the one hand, Basel IV, the U.S. was trying to get Europe to increase capital by not giving so much flexibility in the internal models. And there's been a paradox here that why should we be so worried about the foreigners telling us what to do when we're perfectly capable of having higher capital ourselves. And I'm beginning to wonder whether there isn't a conflict here between the White House and the Republicans in the Congress, because the White House, the president said that many of his friends with good businesses can't get loans. So that sounds like the White House wants lower capital requirements. But the principal Republican project in the Congress says exactly the opposite, as I understand it. The Hensarling bill, the Choice Act, says, hey, let's have 10% leverage capital instead of 6%. So could Simon or Anna or anybody set me straight here? What's the direction of the administration's cooperation with Congress? Is it lower capital or higher capital?
So I'm not going to do the inside scoop, but just frame it analytically, and maybe Simon can give his perspective on this. So the idea is not more capital, all else equal. The idea is if you have 10% calculated in a certain way that may or may not give you 10% in the end, you can avoid all of the enhanced supervision and stress testing and all of the stuff that came with being systemically important. So that is an interesting trade-off, and you can argue about whether, if the number were 50, if even the people who were unbelievably concerned with maintaining strong oversight would just say, look, if the capital cushion is big enough, we'll lay off supervision. Or whether the mix between some minimum capital and supervision and stress testing and everything that goes with systemic importance is the essential framework in which we have to regulate for financial stability.
Yeah, Bill, obviously you should ask them, not me. But capital is going to be lower by this administration and by the Federal Reserve under new management. And I don't think you're going to have to wait long to see this. There'll be a new vice chair for supervision quite soon, and I think the discussion around who can and cannot get that support for that position from the Republicans on the Hill is extremely illustrative and speaks to your issue. The pressure is for significantly lower capital requirements for large, complex financial institutions in the United States.
I want to add something about the Basel Committee. So basically what you've seen in the last few months and weeks about what Bill calls Basel IV and the Basel Committee calls the last chapter of Basel III is individual Eurozone countries, particularly Germany and France, pushing for lower standards, and Dan Tarullo for the Fed, together, by the way, with some European, at least geographically European nations like the UK and Switzerland, pushing for higher standards. Now, Simon told us what the direction of travel is for the US. If that's confirmed, I think you will see another member of the Basel Committee actually become more vocal, and that's the ECB. And the ECB, which is now a full member, as is the SSM, wants higher capital standards. So the ECB has chosen to be silent in this discussion largely because Mr. Tarullo is not silent. And if Mr. Tarullo is replaced by somebody who becomes silent, I expect the ECB to become vocal. In other terms, I can easily imagine 1, 2, 3 years from now, a situation where within the Basel Committee, it's ECB high standards together with, say, the UK and Switzerland versus the US lower standards.
Just one other thought on this, Bill. It seems to me that part of this is a level playing field issue, right? So if the German position prevails, right, to preserve internal models, heavier use of internal models, then it will be an unlevel playing field, and therefore the pressure will be on the United States for level playing field reasons to lower the standards for the same reasons. And it will spill over, and it's also the same issue with respect to stress tests and the CCAR, I never get it right, that CCAR process, right? So that is also something that is would be abolished. Essentially, the CCAR process would be abolished or substantially scaled back under the Joyce Act, right? And that would be, again, a piece that would be erased to the bottom in terms of best practice, as Chris was describing it, being pursued in this area.
Great. So unless Adam has a question. Oh, you have a question?
I have a sort of question and
Excellent.
then
Better make sure it's a question, by the way.
question. Thank you, Ted. In terms of level playing field, I was very struck by Jason's question, which I think was the spirit of what we were going for, and I'm grateful to my 4 colleagues as well as the first panel for raising this. So I think I would have just quickly rattled off a list of things that I think are tangible for the U.S., and then to make it a question, ask whether my colleagues agree or if I'm exaggerating. And then if you do that, then you get fed lunch. So number one, drawing on things that Patrick and Chris said in the first panel, information sharing. That this didn't come up mentioned explicitly in this panel, but you know, when Fortis was blowing up, when we had the mess over Barclays and over Royal Bank of Scotland in the 90s with Japan, not knowing what was going on in foreign banks seemed to imperil things in the US, and even if we were insulated, it made it more uncertain and more difficult for US to transact business. Would that be a cost? A second having to do with crisis mitigation, which Ted, or crisis management, which Ted, of course, emphasized in his policy brief. At some point, you do get chip-ins of people from other countries to some degree. When things get bad enough, you don't want each country saying, oh, this is not my problem, or rather, I can free ride on the rest of you and let the problem get worse over time. You want some peer pressure. It's not perfect. Isn't it possible, aren't there examples where having the international cooperation leads to a somewhat more rapid crisis response? And third, I don't particularly carry a brief for making the world safe for American investment banks, but as Nicola and Bertrand Badre was here earlier and others are well aware, you know, there is a sense in Europe now that after the crisis, there's only a couple American investment banks that rule the world. And if we don't have financial cooperation, won't there be nationalist barriers going up in various places saying, no, Europe has to have its own investment bank, Germany has to have its own investment bank? would that be a cost to the U.S., at least through the lens of the Trump administration? Question mark.
I think I agree with all of information sharing. I mean, Chris explained how difficult it was, and it is, even when there are no barriers, it's difficult. At least that's been always my experience. So sometimes you hide behind this process. I think that's a very good example of where cooperation, I think as you pointed out again, you don't really know about what cooperation is until you need it to solve a problem. And I think that relates to your third point too. I cited in my brief, and I think it's consistent with actually what Chris was talking about herself earlier. You can imagine the consolidated supervision process is a process that the United States has used to keep foreign banks out of the United States. We're required by law, actually, to do the Federal Reserve, required by law to keep banks out of the United States unless we can sanction that they've ever practiced consolidated supervision. You can imagine, take some imagination, but you can imagine that if we start going by our own rules and don't go by the rules that are adopted in Basel, that jurisdictions around the world could say you're under-supervised, you're under-regulated, and you can't do business here. Now, I suspect that's a sort of nuclear option, but it certainly is a possibility. And on your second point, chipping in, that was the part I cut out of my talk, right? The reason why we want the IMF is because it is a large pre-positioned amount of money that we can mobilize instantaneously so we don't have to go to Congress every time we want to and round up the coalition of the willing anytime we want to save one of our friends. Now, if we don't have friends anymore, maybe it doesn't matter anymore.
Nicola and then Anna.
On U.S. investment banks, obviously, I agree. It is very striking when you look at the numbers, and my colleague at another shop, Bruegel, Dirk Schoenmaker, has, together with Charles Goodhart, published very good numbers about it, how dramatically U.S. investment banks have gained market share through the crisis, not only globally, but also in Europe. And they now dominate the European investment banking market in a way that absolutely wasn't the case 10 years ago. So there's a lot to lose here if by clumsiness or neglect or other motivations, the administration gives excuses to European policymakers for having a specifically anti-US investment bank policy. Now, that's a case that I'm sure will be made by the investment banks to the US administration, and I understand, but I speak under Simon's control here, that they have ways to get their opinions conveyed to some key figures in the administration, so I don't know whether we should worry too much, but that's certainly something to be kept in mind. Now, on the information sharing specifically, and that also translates to some aspects of crisis management, I think there's a risk, and perhaps, and again, sorry if that sounds paradoxical, an opportunity, or if you will, a fear and hope. The fear is a breakdown of information sharing to the limited extent that it exists, and Ted reminded us that even in the best of times, information sharing is not great or easy. The hope is that you could have a scenario which in a way did exist to a limited extent in some corners of this space during the Bush years of benign neglect. So you would have a less high-profile role for US financial agencies, and they would be less under the spotlight, and that would give them more space to cooperate internationally. This is not purely theoretical. If I look at the CFTC and the SEC in particular over the last 8 years, I think the public attention on them has prevented them from cooperating effectively at an international level. One example is actually, again, my old obsession about accounting standards. Chair Mary Jo White of the SEC, when she departed, said explicitly that she would have wanted to do more in the direction of IFRS adoption in the US, but she was prevented by all the emphasis on enforcement. And I think this is to be taken at face value to a large extent. So we could imagine that a bit has happened under, again, I'm not a fan of Chair Cox of the SEC for his role in broker-dealer prudential supervision, but I think he was constructive, like it or not, in a number of international cooperation matters, and we could see something of a similar nature in the years ahead.
Anna.
So I want to address two of Adam's points and then put out a broader thought, which is, so first, it's not so much about whether we share information. It is about what kind of information we collect, from whom and how. And a lot of this you heard from Barbara, right? So that, yes, we could do more in information sharing, and if nobody trusts us, that will break down. But there's a more insidious problem, and I think connects with Nicola's accounting obsession. And that is, it's how you count. It's how you collect the data. It's how you report that matters enormously, and that takes you from, can make one institution look solvent one day and insolvent another day. And I think that would be a very big loss that I don't think is quite as politically salient as it should be. And the other point is on crisis response. It is not just about grabbing assets in various jurisdictions for a transnational financial institution, but it is also that for as long as the US dollar is what it is, a big global crisis can back up into the US dollar payment system and become our problem whether we like it or not. And if we are not at the table, if we're arriving to this party at midnight, we're just not in a very good position to protect ourselves. And the alternative is, well, if the US dollar is not what it is right now, then, heck, less risk to us, less exposure to us, maybe we can just go home. So the broader point is this. There is, I think, an inherent contradiction, or a tension at least, between the executive order, which says, advance American interests in international financial regulatory negotiations and meetings as an objective right there and then in black and white, and a piece of legislation that makes us inordinately difficult to deal with, that goes from a regime where we go to a forum and negotiate stuff and then come back and go through our notice and comment process and implement rules and implement legislation, or not, using our domestic control, democratic controls, and a world in which we have to go to the public, to Congress, 30 days before opening our mouth at any of these fora. We're just not worth the trouble in that world. And maybe this is an opening bid, but I think if enacted, it's a different world.
Okay, unless Simon, you say, okay. Excellent. Well, thank you so much for this great discussion. Thanks to all our panelists, and people should get their food as quickly as possible. Every extra minute getting your food is one less minute listening to Nathan.
The Honorable Nathan. Thank you all very much. We will officially reconvene at 1:25. Thank you.